Hi, everyone. We have already talked about broadly the context of the business combinations and the relevant aspects where we briefly touched upon the control aspects. Although, of course, we also discussed that the relevance of the word control would be better understood when we discuss Ind AS 110. Okay, what we would here want to do is basically take the next step where we talk about the entire procedure or entire method with respect to the acquisition of a business. Okay, so while we have dealt with the word business versus the asset and broadly the accounting difference between the two, there is a fundamental difference that we talked about, right? What we want to do now, of course, we want to spend some time talking about how is the acquisition method dealt with in practical life, and there are multiple steps involved, namely who's the acquirer, what is the acquisition date, what is the purchase consideration, what are the assets or liabilities, what is something called as a non-controlling interest, and eventually the measurement or calculation of goodwill or bargain purchase. Okay, now this would be better understood when we look at the framework to talk about understanding who's acquiring, right? It could be interestingly and importantly a difficult question sometimes in terms of who has actually done the business combination or who has done the business acquisition, right? Also importantly, on what date is this acquisition done can also be a question in place. And then how much is that acquirer paying as a purchase consideration, what is that acquirer is taking back as a part of the acquisition, and what is that which is not owning, right? We will be discussing broadly differences between what you control versus what you don't own. So we will be talking about those parameters, and that is where this term NCI has a significance. And eventually, the measurement of goodwill or the bargain purchase. You can certainly use the term as a negative goodwill also to understand the term bargain purchase there. Okay. Now it would be applicable to any business combinations other than when there are transactions of common control, right? Again, there are some terminologies that we'll be discussing in the due course. Common control is where you are talking about entities under the same umbrella. Okay. So we don't deal with these steps when the combination is essentially under a common control. Now, why would it happen? When does it happen, etc.? Is something that we want to discuss at a later stage. This is again, a parameter you want to be very, very comfortable knowing that it can be a question. It can be a question of fact in terms of who's the acquirer. But for each such combination, whenever there is a merger or acquisition, right? You would have heard of a acquisition happening between Vodafone and Idea, right? Now they are both large companies, so in those cases it would be important to establish. I'm not saying that one company is the acquirer or the other is the acquirer. There are all facts and circumstances that need to be seen, but for every business combination or each business combination, one of the entities shall be an acquirer, right? And what you also want to remember here is that acquirer is the one who controls and therefore consolidates. Okay. So the word control and consolidate or consolidation, they really come handy. They really become very, very critical in this entire phenomenon of group accounting, right? So we shall be discussing, of course, that when the time comes. But the only thing that you want to remember, in case there is ever a business combination, right, there has to be an acquirer for sure. If there is no acquirer, then probably that there's no business combination in itself. That's what you want to kind of look upon, and that's what we say. Acquirer is the one who obtains control over the other entity. Okay, we talked about the example of Facebook acquiring WhatsApp, or we can also talk about example of Microsoft acquiring shares in LinkedIn. Okay, or they acquiring Skype as a business, right? I mean, you talk about Google as a company, they keep on acquiring a lot of businesses around. Okay, so you start looking at all these aspects of, you know, there has to be an acquirer in place, and the acquirer is the one who controls and therefore consolidates. Okay, again, emphasizing upon the fact that we don't know at this point in time what is meant by control. So we will leave that discussion still here, right? But then you will see when we discuss the word control under Ind AS 110 framework, then you would be able to appreciate the nexus or the relationship between the two standards coming in together. Okay, so Ind AS 110 would reflect entirely how do you identify who's controlling and therefore becoming the acquirer, right? But importantly, we want to just bring along here. So we don't want to discuss what is control here at this point in time. This is something we want to discuss at a later time frame when we discuss, Ind AS 110. But in case there are no clarifications available, or in general, when you look at an acquisition taking place, in general, importantly, not a rule, usually the acquirer is the one that transfers the cash or other assets or incurs the liability, or the one that issues shares to the other entity's shareholders in return of the acquisition. Okay, or it could be a combination of both. They could be issuing both shares and cash. All right. Again, post combination, right? Normally, acquirer has the largest portion of the voting rights. And then there could be yet another indicator that the acquirer will have the ability to elect or appoint or even remove. So all decision making with respect to the, the governing body, or the board of director, for example, right? So all those decision making with respect to the appointment, removal, etc., that lies with the acquirer. Okay, that is something that you just want to kind of take into consideration here. Okay, now this is something wherein it becomes even more critical to understand in case there are two companies. So let's say there is a company A and there is a company B, right? They are both independent companies. They both dissolve and become a single company, which is company AB. Okay, right? Now, what would happen normally in this case? AB will issue shares to the shareholders of A as well as to the shareholders of B. Okay, so effectively, both A and B are no more in the business, right? They simply dissolve or they merge themselves into a single company, AB, right? And this new company, basis whatever is the valuation, let's not worry about that part. Okay, basis the valuation, they issue shares to both the shareholders of company A as well as company B, right? Now, the context is that, are we actually talking about a business combination here as well? Is there an acquirer in place? Because practically, both the entities who were into existence, they are not into existence anymore. Okay, vis-a-vis a new company coming into the picture. So is this new company the acquirer? That's what the question is all about. Okay, now it is not always straightforward, right? It's not always straightforward, and that is where there are two extreme possibilities which can exist. So let's talk about those. It says that where a new entity, a new company, let's say in our case AB, is formed to affect business combinations between, let's say for the simplicity's sake, we have taken two companies. It could be more than two companies also, right? So let's say B and C. So we just took an example. Ind AS 103 identifies two distinct scenarios. One is that the new company issues its shares in exchange of instruments of the existing companies A and B in our example, right? Now, in this scenario, very importantly, only one of these old entities can be the acquirer. That's what is mentioned. Either company B or company C. So if you look at from the example that's given in the slide, should be identified as the acquirer. Okay, wherein you would probably be able to judge that by, for example, understanding probably AB issues 70% shares to A, and of course remaining 30% shares to B. Very straightforward. This majority voting right available with A or the shareholders of A suggest that it suggests that company A is the acquirer, because the eventual decision making, eventual control over the decision making of AB, the combined entity, vests with or lies with company A. Okay, it is not a rule, but it's a likely indication suggesting that this is the possibility. When are we looking at it? When, for example, the new company is issuing its own shares. Okay, that's a simple scenario. But then you might also see that AB, for example, pays cash to acquire, let's say, stake in A or B, or A and B for that matter, right? It might have arranged for some, funding from third party or from bank for that matter, and it is returning the consideration back to those entities, right? In a way, it is acquiring the business of A as well as B, and it's obviously repaying it back. Whatever it is acquiring, it is paying for that value. Okay. In that scenario, the new company, AB in our example, may become the acquirer itself. Again, it's not a rule, but you get some benchmarking around it. You get some, you know, in hindsight, you get to know about it, that yes, that appears to be the case in this scenario there, right? So when we say that the new company transfers cash or other assets in exchange for equity instruments in the existing shares of those shareholders of those companies, for example, the proceeds of a debt or equity issue, etc., then the new company may be identified as the acquirer. Okay. So when I say that, I'm looking at this perspective. Let's talk about the practical scenario. It says that two existing businesses, Super Limited and Duper Limited, are carrying on business independently. The two businesses decide to merge by creating a new entity called as Awesome Limited. Now, Awesome Limited issues equity shares in itself in the proportion 1/3 to the equity shareholders of Super and 2/3 to the equity shareholders of Duper Limited. The question is required to identify, should Awesome Limited be regarded as an acquirer? Again, you bring that thought process. There's a Super Limited and there is a Duper Limited, and there is a new company, Awesome Limited, created, right? Now, when you see that the new company is issuing shares 1/3 to Super and 2/3 to Duper. Okay, effectively, you can think of this combination in a more practical scenario. Let's say, if I take you back there, let's say this company has 1 million shares of 20 each. Okay, and let's say this company also has, or let's say for the sake of argument, 1 million shares at the rate of 40 each. Okay, so effectively you look at the value of this business, which is 20 million, and the value of this business, which is 40 million. Okay, now what Awesome Limited is doing, the new company is doing, it is issuing, for example, 1 million shares at 20 back to Super Limited shareholders, right? Its own shares. So the value of the share is, let's say, measured at 20 rupees each. Okay, but what it also does, it issues, of course, because the share value is 20, to give the equivalent value of 40 million, it shoots 2 million shares to the shareholders in, let's say, Duper Limited, right? So what are we looking at is basically the total number of shares are 3 million, of which one third are issued by Awesome to Super and two-third are issued by, of course, Awesome to Duper Limited, right? Effectively, this 20 is a value which is created because both Super and Duper were combined together. Okay. Awesome Limited, the combined entity in itself is not bringing anything new from the market. Okay. Awesome Limited has no role as far as the creation of value, as far as giving it back to Super or Duper Limited is concerned. So in that sense, we look at whatever is given by those two entities, Super and Duper Limited respectively, whosoever is getting a higher proportion of, let's say, shareholding in the merged entity is likely, the is considered to be the acquirer, right? And when he's the acquirer, then the accounting follows in the books of, the merged entity, wherein Duper Limited is considered as an acquirer, right? Now, how does the entry go? How does the accounting go? We are as of now not worried about it. What we are rather looking at, what we should be very, very comfortable understanding here is purely understanding under what circumstances or who shall be an acquirer in what kind of scenarios. Okay. So when you look at this scenario, it says that Awesome Limited cannot be identified as an acquirer purely because of the fact that there is no value creation done by Awesome Limited. Awesome is not giving anything back really to Super or Duper specifically, right? It is simply returning back whatever they gave it to him. Okay, there is no consideration in form of cash or a value, etc. Okay, had it been a case where probably Awesome Limited had managed to, let's say, get some cash, and they would have distributed both to Super and Duper, in that case it is very likely that Awesome Limited could have very well been an acquirer. So he's acquiring two entities in this scenario, if for example it is paying cash. Okay, so what are we saying is that in the present scenario, Awesome cannot be identified as an acquirer. Either of the combining entities would be identified as an acquirer. In the given scenario, very likely Duper Limited should be the acquirer purely because of the fact that, the majority shareholding in the merged entity lies with Duper Limited. And accordingly, the accounting for the business combination would work as if Duper Limited had acquired Super Limited and eventually turned out to become Awesome Limited. Okay, right. Now, this is another scenario. This is a little typical where we talk about what if you don't have the voting rights today, but you probably will have those in some time. For example, it says that Mark Limited, a manufacturer of shirts, acquires 90,000 of the shares in Peter Limited, a manufacturer of trousers, out of 2 lakh issued shares. So it's 45% shares that are now coming to Mark. As part of the same agreement, Mark purchases an option to acquire additional 40,000 shares, right? The option is exercisable at any point in time in the next 12 months. It includes a small premium to the market price at the date of transaction, right? So in a way, whatever the fair value of the option, you're paying a little extra premium for that. After the above transaction, the shareholding of the two other original shareholders are 70 and 40 respectively. So effectively, we are saying there is 90 plus 70 plus 40, that makes, of course, 200, right? So Mark Limited will have 90,000, shareholder 1 will have 70, and shareholder 2 will have, of course, 40,000 shares, right? Now, each of the shareholders also has currently exercisable options to acquire 5,000 shares each. The question is, you're required to determine whether the control is acquired by a Mark Limited. Importantly, what you need to understand here is that if you look at the total number of shares outstanding post this let's say, agreement, we are saying that Mark has got 90,000 shares, which is 45%. Shareholder one has got 70,000 shares, which is 35%. And the second shareholder has got 40,000 shares, which makes it, of course, 20%. This, of course, becomes 100% there. But essentially, Mark has also got an option to acquire another 40,000 shares, which means that if this were true, if this would have happened, the total shareholding would have been 1,30,000 shares. But of course, we are also provided that the other two shareholders also have the options to so exercise, options to take another 5,000 shares each, right? That makes it now 75 plus 45 would be 120. So that makes it 250,000, right? So that's 250,000 shares. Now, if this option were exercised, right? If these are options were exercised, the stake that Mark has got in that new business is more than 50%, right? Of course, we're talking about majority voting rights. Has it got it currently? The answer is no. But does Mark have a right to exercise the option so that it can get into the, the controlling situation, or let's say having the majority stake? The answer is yes. The option can be exercised at any point in time. The option can be exercised at any point in time, right? Seeing that perspective, we may agree that Mark has acquired control in that other company, which is Peter. Okay. Of course, the argument holds that there is a premium as far as the acquisition of those additional shares are concerned. But then for a controlling stake, probably the premium could be justified. It is not a significant amount, but a fractional amount, something which is a little more, as it is referred to as the word small. It is a little higher than the market price, but from a controls perspective, to run the business for that matter, probably that is something which is, a part of the arrangement as well, right? So in that context, what I was saying is that even if the agreement does not give you an outright majority, because the total would be 90 out of 200, which makes it 45%. But the option allows you to have that majority because that is also exercisable at any point in time, right? That is where it indicates that Mark Limited is the potential, acquirer in this case, and where, we can say that the Mark Limited is actually, an acquirer of, a stake in Peter Limited, and thereby has a control over the business of the other company, right? Says that in assessing control over Peter Limited, Mark should not only consider the 9,000 shares, but also the potential voting rights to acquire those 40,000 shares. The specific terms and the conditions, etc., are of course considered, since the options are currently exercisable, and in case these are exercised, then the stake would be, of course, more than 50%, right? Even though, for that matter, the other shareholders also exercise the option, the majority, which is more than 50%, still remains with the Mark, right? The premium is small enough, and of course, a majority would probably be, exercised. I mean, the premium would not restrict, for example, Mark to exercise that option, and of course would have the majority ownership coming in, right? In all these cases, considering all the above factors, it is okay to consider that that Mark Limited would, with the existing stake of 90,000 shares, and further stake possible potential shares of 40,000 shares, it is having the control over the other entity. So in a way, we are saying that Mark Limited becomes the acquirer in the given scenario. Okay. It says that it's more of a discussion in terms of it could be an acquisition of a company through payment of cash or incurrence of liability. Again, the same thought process where you look at, for example, there is a new company formed, right? But it issues shares in the open market, collects cash, and with that cash acquires another business, right? So in that sense, this new company is essentially the acquirer, right? So we are talking about that context here. In a business combination affected primarily by transferring cash or other assets or by incurrence of liabilities, the acquirer is usually the entity that transfers the cash or other assets, or for example, that incurs a liability. Okay, let's have a look at this example. In a spin-off arrangement, Sun Limited, the parent entity, decides to separate two of its businesses, which are currently being housed in two separate entities, namely Mercury Limited and Venus Limited. A spin-off simply means you're splitting the business, right? So you're looking at the two businesses within Sun Limited, namely Mercury and Venus, and Sun Limited decides to separate those. Now, to facilitate the arrangement, Sun Limited incorporates Earth Limited, which is a new entity with nominal equity. Okay, there's a new company coming in place. Okay, and this new company purchases both, for example, Mercury and Venus in cash, subject to, of course, let's say, availability of funds. And then Earth Limited, in fact, goes in the open market and gets those, gets that funding now. Okay, now effectively, once everything is has taken place, so at the conclusion of the transaction, Earth Limited is around 95% by the new investors, with Sun Limited retaining 5% NCI. So what have you done, from Earth Limited's perspective? So when we go back there, so Sun Limited had both Mercury and Venus, right? For the sake of argument, let's say there is a 100% stake that Sun has got both in Mercury as well as Venus. Okay. Now there's a new entity formed, which is Earth. It issues shares in the market, obtains cash, and now takes 95% stake in these entities, wherein Sun Limited is only left with 5%, right? Now, in this case, we can safely conclude that Earth Limited is indeed the acquirer. Okay? Earth Limited is indeed the acquirer because it is able to take that control. It is able to acquire the other business by transfer of the cash. Okay? Sun Limited would no more have, let's say, control over Mercury or Venus, and it is fundamentally different from the previous example that we discussed, the new company example, the B and C or the A and B we talked about. Had Earth Limited issued shares to the shareholders of Mercury and Venus, which is essentially Sun Limited, okay, in that scenario, Earth Limited could not have become or could not have been called as the parent entity. Okay, merely issuance of shares would not give, for example, the opportunity to Earth Limited to be called as a parent entity. So that's where you start looking at a fundamental difference between how do you look at a scenario where a new company is formed by issuing its own shares to the existing shareholders. So versus in this scenario, wherein the new entity is is transferring cash to acquire the business of the other two entities there. Okay. In the given case, as we said, Earth Limited is going to be the acquirer for sure. All right. Of course, we are given that a set of new investors paid cash to obtain control of Earth Limited in this transaction, but Earth Limited is used to effect the acquisition of 95% shares by paying cash. Thereby, Sun Limited loses control and Earth Limited, even though it's a new entity, it becomes acquirer. Okay, so that is something which is you need to kind of pick up as a concept. Okay, from an examination standpoint, you need to be very, very comfortable. All right, you need to be very, very comfortable understanding who is the acquirer. Okay, we still have more examples to discuss that. All right, we are saying that when you are issuing shares, for example, right? So when there is an acquisition through the issue of shares, normally the acquirer is the one who issues shares to the other entity. But then there could also be instances wherein the shares issuer, the issuer of the shares is basically, or the issuer of the share itself is the company which is being acquired. Okay, reverse acquisition. We'll be discussing a couple of questions around that. What you need to remember here, what you need to be knowing for sure here is that all these aspects are critical from an examination standpoint, right? Your examination has tested these aspects in the past, either as a standalone question involving a lot of calculations, or even as a part of a concept, right? So you cannot take it, take it for granted that you understand everything. You should be, of course, very open to read more, talk more about all these concepts to be able to, for example, explain those facts. Okay, so we're saying that acquirer is usually the entity that issues its own shares. However, in some business combinations, even the issuing entity could be the acquiring, right? What you need to remember, who has the relative voting share in the combined entity. Okay, for example, where does the majority lies in that combined entity as far as the voting rights are concerned? How about the composition of the governing body? So it can happen that one entity has a voting right, but the other entity governs the composition of the governing body, or manages the governing body. So you need to be careful in assessing all these things, right? What is the composition of the senior management? What are the terms of the exchange of those shares? Now, again, we also tend to believe that acquirer is usually the entity whose relative size is significantly bigger or significantly greater, right? In an examination scenario, you normally would be able to identify that very comfortably. But as a concept, you should be well aware of it, because in real life aspects, this could be really, really challenging. And to some extent, your examiner can test your knowledge or expect to test your knowledge on these parameters as well. Okay, let's have a look at this example here. It says that Purple Limited and Orange Limited operate in biochemical industry. Purple has a larger operation compared to Orange, and therefore Orange Limited merges with Purple in a business combination. So it's a merger basically, wherein Orange is becoming a part of Purple. All right. It says that the purchase consideration is that shareholders of Orange Limited would receive one share of Purple for every 2 shares held in Orange. And then such issue of shares would comprise 15% of the issued share capital of the combined entity, and because of which the pre-merger shareholders of Purple will continue to hold 85% of the share capital of Purple Limited, right? Effectively, we are simply saying Purple and Orange are 2 entities, but they become a single entity, Purple, right? So they combine with each other, right? So they become a bigger company, Purple, but Purple's 15% shares will go to the shareholders of Orange, and the remaining 85% shares will continue to stay with the existing shareholders of Purple Limited. The question is, you're required to identify as to who shall be the acquirer in the given case, right? Imagine again multiple factors, right? One is, that Purple is larger in size. Okay, that Purple is issuing shares to the shareholders of the other entity, right? And then the majority stake still lies with Purple Limited. Okay. So the size of the business, which was a relevant factor, is that of Purple, which indicates that Purple is the acquirer. The issue of shares is done by Purple itself to the shareholders of Orange. So again, somebody who issues shares, somebody who parts with the voting rights is normally the acquirer. Again, that indicator is met. And then importantly, or maybe another very relevant aspect is that in the merged business or in the combined business, who has the majority shareholder, which is again Purple, right? So all these factors would indicate that Purple is indeed the acquirer in this case. Okay. In this transaction, Purple Limited is the acquirer because by merging the entire shareholding, Purple has acquired control. Likewise, the Orange, the shareholders of Orange, right? They do not any which ways control because they hardly have 15% of the share capital of the combined entity. So, look at all these factors. You can list them while trying to explain this aspect of who controls or who is the acquirer in the given case. Okay. Let's have a look at yet another example. Now, this is a bit typical scenario. We'll be discussing that very, very diligently. It says that during the year, Sun Limited incorporated Earth Limited. The objective of incorporating Earth Limited was to acquire 100% stake in Moon Limited. Okay. So effectively, Earth is a new company, of course, which is controlled by Sun Limited. But then the reason why Earth exists is because Earth must acquire 100% stake in Moon Limited. Okay. Now it says that to fund the acquisition of Moon Limited, Earth Limited acquired a loan at commercial interest rates from another bank. Okay. And the loan funds are used by Earth Limited to acquire entire voting rights at fair value in an orderly transaction. All right. And finally, post the acquisition, Earth has the ability to dominate the management of Moon Limited and also elect, appoint, and remove a majority of members from the governing body of Moon Limited. The question is that you're required to determine, can Earth Limited be identified as an acquirer in this business combination? Now, think about it all, what's happening. As of now, let's take Sun Limited out of the equation. Okay. Let's assume that there is only Earth Limited and then Moon Limited. So what is happening? Earth Limited goes to bank and acquires funds. Okay. At a normal commercial terms, there's nothing which is, suspicious about that transaction also. Okay. Now these funds are used to acquire shares in Moon Limited. And after this has happened, all the voting rights and governing body, they all pertain to, they all go to the Earth Limited. So if I were to look at it, Earth Limited has transferred cash. Earth Limited has 100% stake in Moon Limited. Earth Limited also has the power to control the governing body as well, of course, of Moon Limited. So given these aspects, we may want to say that Earth Limited is indeed the acquirer. All right. This is something that we have studied so far. But now we want to also talk about Sun Limited. Okay. When you talk about the role of Earth Limited, The question that arises is that why is it even coming into existence? Okay, why is Earth even there? Okay, the reason why Earth Limited was incorporated was that it was incorporated so that it can acquire stake in Moon Limited. All right, effectively it was Sun Limited who wanted to acquire Moon Limited, but instead of doing it directly, it brought Earth Limited in between. Okay, so no matter the transfer of cash, the 100% voting rights, and the governing bodies decision making all lie with Earth Limited, but purely this is a transaction, undertaken on behalf of Sun Limited. Okay, so importantly in this case, what we want to conclude that the key drivers, etc., would be there, and of course, Earth Limited has, of course, the right to, let's say, ability to dominate, etc. And we may conclude further that Earth Limited is the acquirer, but you do not want to ignore the fact that if, for example, Sun Limited created that company and probably indirectly wishes to control Moon Limited through Sun Limited. Okay. In that context, Sun Limited is presumed to be the acquirer. Okay. But if that is not the case, right, that's what we want to explain here. If that is not the case, then Earth Limited may be concluded or considered as an acquirer, right? So we need to look at all those facts and circumstances to be able to establish that aspect in terms of who is the acquirer in this case, right? In an examination standpoint, right, it is important to also bring into consideration the role of Sun Limited. Okay, so you can bring it along if Sun Limited eventually, let's say, wishes to have the control or the decision making power in Moon Limited, and that's the reason why Earth Limited was established. Okay, so then Sun Limited would be considered as an acquirer. However, if that does not appear to be the case, right, then Earth Limited can certainly be considered to be an acquirer in this case also. Okay, right, great. Now, this is something that we want to briefly talk about here, where we look at the word reverse acquisition, right? Let me use some space to be able to explain what exactly is the context here. We are saying that reverse acquisition occurs when the entity that issues securities is identified as the acquirer for accounting purposes, and the entity whose equity interests are acquired must be the acquirer for accounting purposes for the transactions to be considered as a reverse acquisition. It's technical here, right? But let's talk about it in terms of what it states. We are saying that there is a small listed company, just a hypothetical scenario in terms of explaining why such kind of acquisitions or reverse mergers or reverse acquisitions take place, and how do we deal with that part. Okay, we're saying that there's a company X, which is a small listed company. Okay, and there's a company Y, which is a large private company. Okay, right, let's say they are in the same business, they're in the same industry, for example. Now, for the sake of argument only, we are saying that company Y intends to get into listing. Okay, it wants to get itself listed, but then it also understands that getting into listing is a lot of paperwork, a lot of documentation, a lot of approvals, etc. required. Okay, and it does not want to wait that long, right? Compliances can be really painful sometimes. So it does not want to wait that long. So what it does, right? So let's say this company is probably worth, you know, worth 100 crore rupees, and this company is, let's say, worth 500 crore rupees. Of course, the only difference is that this is a private company, and the company which is worth 100 crores is a listed company. It's a public company. Okay. Now, what company Y does, right? Company Y merges itself into company X. Okay. So in theory, or as a transaction, we want to say that company X has acquired company Y. That's what we want to say, right? Because in a way, Y is getting merged into X, right? But now we also want to talk about it like this, that this company X, which was worth 100 crores, well, fundamentally it becomes worth 600 crores, because the value of Y is getting into the value of X also, right? The total value of X is the value of X plus that of Y. So in principle, or fundamentally, the value of the new or the merged businesses now is 600 crores. So what company X is doing, company X issues shares worth 500 crores to the shareholders of company Y. Right? That's an even transaction, of course. That's the only way, of course, it is expected to happen, right? So we are saying that company X issued shares, right? So ideally it should be the acquirer, right? Company Y gets or becomes a part of company X. So any which ways, company X should be the acquirer, right? That's fundamentally okay. There's nothing wrong in that. But realistically, what has happened? What has happened in substance, right? In substance, we are saying that the legal parent is company X because Y becomes a part of company X. X has issued shares to company Y. But when you look at the spirit of this transaction, when you look at the crux of this transaction, in this new entity, in this larger entity, company X, who has the majority shareholding? It is the shareholders of company Y, who have 5/6 of the value, right? 500 plus 100 becoming 600, out of which 500 crores worth of shares are with the shareholders of company Y. Okay. So in that sense, we are saying that even though company Y's shares were acquired, for accounting purposes, company Y is considered to be the one who has acquired company X. And that is where it becomes an accounting parent. And that's why the transaction is referred to as a reverse acquisition. Right? This acquisition is claimed to be an example of a reverse acquisition. So what are we trying to say here? What are we trying to conclude here is that the public entity in our example is the acquiring. Public entity means the company X, right? And the private entity is the acquirer. So company Y becomes the acquirer only for accounting purposes. And for us, accounting is important. Okay. And that is where you start looking at everything in terms of how this entire, for example, transaction be dealt with, right? What you want to remember in this case is that when you look at a scenario where there's a reverse acquisition, try to understand not who has issued shares, but look at it in that acquisition or post that acquisition, which company has a majority stake, which company has a larger proportion of the shareholding, is the parent company, right? And accordingly, the accounting will flow, right? Usually, the smaller entity or the smaller company will be the acquired business or the acquiree. The larger company will be the acquirer or the parent company in this scenario. All right. That is something that you want to pick up as a context when you look at this scenario. How does the accounting work? We will be discussing that all, in the due course. We need to understand these aspects of who's the acquirer at this point in time, and then we would be able to appreciate in terms of how to deal with the accounting part of it and how to, let's say, solve those questions which are arising under different scenarios. Okay, this is the last section of this aspect of who's the acquirer. There could also be a combination, for example, without a consideration. Okay, let's take a smaller scenario. Let's say there's a company XY. Okay, it has three shareholders. Let's say there's a company A, company B, and company C. Okay, say for the sake of argument, A has 40% shares. Okay, B has 30% shares, and C also has 30% shares. Okay, now there's nobody who has, for example, let's say, a majority stake, more than 50% shares, right? So what happens that company B after some point in time, company B cancels its shareholding. Okay, so in a way, we are only left with company A and company C with 40:30 proportion. Okay, 40% stake versus 30% stake. Okay, as per the original arrangement. Now, what has happened here, right? We are saying that since the existing shares of company B, they have been, they have become, they have lapsed, or they have been cancelled, or they are not into existence anymore, right? So in that context, we are saying that A has been able to achieve a majority stake in the new set of operations. Okay, A is not paying anything, right? But then we are simply saying that A is able to obtain control even without transferring any consideration. Okay, and essentially what we are trying to say that the accounting under Ind AS 103, the acquisition method of accounting for a business combination, would apply even in these scenarios, right? How does it happen? At this point in time, we don't want to bother, but what we want to pick up here is that, right, even if there is no consideration transferred, as in this scenario, A is not giving anything to B or C for that matter, there is a majority stake achieved, where you look at, of course, the entity, for example, XY is repurchasing sufficient number of own shares from an existing shareholder. So the cancellation could also be a buyback, right? And once that has happened, then the acquirer, which is for example, company A in this case, is able to have a majority stake and of course have a control coming in. Okay, and that is where purely by means of this arrangement or a contract, etc., there could be a business combination in place. Okay, it's a little theoretical here, but something that you want to really get comfortable with. All right. Again, the examples could be multiple examples. There's two businesses which are coming together under a stapling arrangement, or there could be an arrangement where there could be a dual listing corporation, right? In those cases, you need to be, again, following that there is an acquirer in place, and accordingly the business combination and all those related transactions, in terms of identification of assets and liabilities and goodwill, etc., that also need to be calculated on that basis, right? But then just you want to kind of bear in mind, you just want to keep that thought here, that in case there is a transfer, there's no consideration being transferred. Even in those scenarios, it is possible to achieve, let's say, a business combination there. All right. Right. Let's do a revisit of what we have discussed so far. We say that there are there are largely indicators available to identify who's the acquirer. Somebody who transfers cash, somebody who issues equity stake, somebody who has the largest portion of the voting rights in the combined business, or for that matter, has an ability to, run the operations, right? Have rule the governing body. Okay. You also need to consider importantly the voting rights to the extent exercisable, and the word control. We want to understand that, of course, eventually in the due course. And that's where you start looking at all these aspects coming in the picture. Where you look at acquisition through equity shares. Somebody who's normally issuing its shares is the acquirer, or somebody who's transferring the cash or assets or assuming the liabilities in the other business is usually the acquirer, right? Similarly, an important point to follow, under a reverse acquisition, it can happen that the acquiree is the legal parent, but the acquirer would be the one on the basis of whose books the accounting will be done. Okay, that is something that you want to remember at this point in time. All right, thank you very much.